Hello guys, myself Rishish Meher from St. Teresa's Convent School. I am here on the behalf of our St. Teresa's Boys group presentation, and we are going to give a presentation about stock market. So first of all, I am going to introduce my team. So the presentation is led by me. The members are Raj Sharma, Aryan Das and Vinamr Sahu, and the presentation will concluded by Shashwat Singh. Now moving ahead, first of all I will tell what we will going to say about stock market. At beginning we will understand what is stock market, then who introduced it, how the trading is done in the stock market, then the how many stock exchanges are in India, how many types of shares are available. After that we will see what are the full features and merits and demerits of the shares. As moving ahead, who introduced the stock market? Stock market is introduced by Premchand Roychand in 1875. According to Premchand, a stock market is a place where people buys and sells the shares of a public companies. Let's see, if a person wants shares of Reliance Industries, then the stock market will help him to meet the seller. Now we will see how the trading is done in the stock market. So this buying and selling of the shares are done by stockbrokers. They are the middlemen between investor and stock exchange. Now we will see who is the broker. It is a person who acts as a link between investor and the stock exchange. They acts like as agents and charges the commission for their shares. They are registered with FINRA. Now we will see what is dividend. It is an income, it is a reward for an buyer. It is decided by the board of directors of a company and with shareholders approval. In short, it is a part of a profit that the companies issues or shares with the shareholders. Okay guys, this is all about the introduction about the stock market and how the trading is done in the stock market. Now our member Raj Sharma will continue and tell you about the stock exchanges are in India.
Hey guys, myself Raj Sharma from St. Teresa Convent School, and I am here to tell you about the stock exchange in the India. So there is the major two stock exchange in India. First is National Stock Exchange NSE. Second is Bombay Stock Exchange BSE. Now I am going to inform you about National Stock Exchange NSE, which we also known as NSE. So National Stock Exchange of India, befitting stock exchange of India, which we located in Mumbai, Maharashtra. The NSE was the first established in 1992 as the first dematerial electronic exchange in our country. NSE has a market capitalization of more than 3.4 trillion US dollars, which will become 25 lakh crore rupees in Indian currency, which makes it world largest stock exchange in the date of August 2021. And maintaining is that the stock exchange helps companies to raise capital by the issuing shares to public. And now I am going to share the details about Bombay Stock Exchange BSE. So BSE Stock Exchange is the first stock exchange of Asia. It offers varied services like market service, helps in risk management, helps in CDSE, which we known as Central Apology Service Limited, Central Depository Service Limited, and in the some depository service and etc. BSE is the 12th biggest stock exchange in the world, and its and market capitalizations of 87.7 billion something in 2021. Thank you guys.
Thank you Raj for informing us about stock exchanges in India. Now I am going to inform you about equity shares. So first of all we have to understand what is equity shares. Equity shares are those shares which are non-redeemable in nature. In equity shares the person invests in his money while startup, and he can only redeem his money when the liquidation of a company is done, which means when the company gets closed. Equity shares is for long-term financing. These shareholders have a right to elect the board of directors, means they are having voting rights to elect board of directors. Now we will discuss its features. First of all, equity shares, it bears high risk capital. It is a permanent capital to company. Its dividend varies with the performance of a company, and all the amount which are left after distributing all the money takes by equity share. See, if a company distributes the all profit to the shareholders, then after distributing all the shareholders, the money which are left after distributing all the monies are taken by equity shareholders. They are voting rights to elect their board of directors. They are having limited liability. Now we will understand what are the merits of the equity shares. It is suitable for investors who can bear high risk for high returns. It depends on the profits available and the decisions of the board of directors. It serves as permanent capital to the company, and it enjoys voting rights. Now moving ahead, we have to come in demerits or limitations of equity shares. First of all, it is not suitable for those who desire to earn stable return. Its cost is high as compared to others. It dilutes the control of shareholders. It has to go with many legal formalities. If company has raised excess capital due to then faulty planning, they remain idle and underutilized. So that's all for about equity shares. Now my friend Aryan Das will inform you about some other details which are happening in stock market day to day.
Hello everyone, I am Aryan Das. I am here to talk about investments and some advantages and the risks which are associated with these investments. First of all, we will see why we should invest in equity shares. First thing is that by equity shares we earn high income, because when we invest in equity then we can mature that dividend when the liquidation of a company is done. It helps against inflation. Suppose we have done expense of 25,000 in 2020, then in the same thing we have invested 28,000 in 2021. So there is a difference of 3,000. This thing is called inflation. Then comes portfolio diversification. Portfolio diversification is the process which reduces the risk of a particular asset. People usually fear to invest in stock market. I am going to tell you 8 ways for overcoming investment fear. Number 1, education. Education is very important for stock market. So firstly, educate yourself about stock market. Number 2, we should set investment goals on daily, weekly and monthly basis. Number 3, we have to look at the bigger picture. Number 4, at first we should start with a small amount. Number 5, you must have a strategy. Number 6, you should use simple approach. Number 7, you should find an investment and then invest in it. Number 8, courage is very important, so don't become discouraged. Now let us talk about advantages of investing in stock market. One of the major benefits of investing in the stock market is that investors get the chance to earn more money. Over time, if the stock market rises in value, the prices of a particular stock can rise or fall. However, investors who have put their money in stable companies will see profit growth. So when you will invest in the stocks market, you should analyze all the things about the company and the stocks which you are going to invest. In stock market, risk is also involved. Risks associated with these investments are The risks of investing in equity include share price falls, receiving no dividends or receiving dividends lower in value than expected. They also include the risk that a company restructure may make it less profitable. Alternatively, a company may fail. So guys, that's all from my side. Thank you.
Thank you Aryan for your explanation. Now my friend Shashwat Singh will tell you about preference shares. What are done in the preference shares? My friend Shashwat will tell.
Hello everyone, myself Shashwat Singh and I am here to explain you everything about preference shares. So let's begin. It is a type of shares which enjoy certain priorities regarding the payment of capital, which means that if you will invest in a company with 5% of rate, then when you will take your dividend, you will also get same rate of dividend. And if a company has not told their profit of particular year, then preference shareholders are having right to receive repayment of their capital which they are invested in company. Then features of preference shares. First, fixed rate of dividend. That is, the preference shareholders will receive dividend at a fixed rate only and also before any dividend is paid to equity shareholders. Second, repayment of capital. The shareholders have right to claim the assets in case of wind up of a company. Third, no voting rights. Preference shareholders are not having rights to vote. Fourth, no charge on assets. Preference shareholders also issued creating any charge on the fixed asset of a company. Then, types of preference shares. First, cumulative preference shares are those type of shares which carries the right to accumulate unpaid dividend in future years. Second, non-cumulative preference shares are those type of shares which does not carry the right to accumulate unpaid dividend in future years. Third, participating preference shares are those type of shares in which shareholders are granted the right to share in the surplus profit of the company. Fourth, non-participating preference shares are those type of shares in which shareholders do not carry the privilege of participation of surplus profit along with equity shares. Fifth, convertible preference shares are those type of shares that can be converted into equity shares within a specified period of time. 6. Non-convertible preference shares are those type of shares that cannot be converted into equity shares. Moving ahead, merits of preference shares. It is useful for those investors who want fixed and steady income. Second, it does not influence the control of equity shareholders over the management. Third, it is entitled to receive fixed rate of dividend. Preference shareholders are able to declare higher dividend. Fourth, they have a preferential power of repayment over the equity shareholders. Fifth, any sort of charge against the assets of a company is not created by the preference capital. Moving ahead, limitation of preference share. First, investors who are willing to take a risk and earn higher returns do not prefer preference shares. Second, preference capital affect the claim of equity shareholders over assets of the company. Third, there is no consistent return for the investor because the dividend is payable to the preference shareholders only when the company earns a profit. Fourth, dividend paid to the shareholder is not deductible from profit as an expense and there is no tax saving also. So that's all about my topic.
Thank you Shashwat for your wonderful explanation about preference shares. So let's recall what we have discussed by this presentation. A stock market is a place where the shares of a publicly listed companies are being traded. It is introduced by Premchand Roychand in 1875. The trading of shares are done by brokers. They are the mediators between the people and the stock exchanges. After that, when we invest our money in stock market, we get dividend, or we can say it is income or it is a reward. Then we have discussed about stock exchanges in India. So there are two stock exchanges in India. NSE, which we call as National Stock Exchange, BSE, which we call as Bombay Stock Exchange. Then we have seen there are two types of shares. First is equity shares, second is preference shares. The equity shares are those shares in which the people invest their money when company starts, and they can mature that amount when the liquidation of a company is done. That is, which means the company when gets closed, then also the peoples can mature the amount. Now, as moving forward, the preference shares are those shares in which the people invest their money and they can mature that amount with fixed rate of dividend. Suppose if you have invested your money in any company with a fixed rate of 2%, then if a company will rise, then also you will get fixed rate of dividend of 2%, and if a company will fall, then also you will get the dividend with a fixed rate of 2%. So at last, I am very grateful to our coaching commerce circle and our respected Upendra sir who gave us a golden opportunity to represent ourselves with the topic of stock market. So thank you guys. Hope you will all like our presentation.